So that's the real advantage, is knowing all this and being very clear. Then we find the best option based on the overall scenario.
Welcome to the Investor Financing Podcast, where we interview real estate investors and lenders so you can learn all the secrets to getting your projects funded and scale your portfolio. And now, your host, Bo Eckstein.
Hello, this is Bo Eckstein with the Investor Financing Podcast. And on today's show, we're going to talk about short-term rental financing options for refinancing properties. So it's a little bit more challenging purchasing a short-term vacation rental, specifically if it doesn't qualify from a debt service coverage standpoint, and you have to use projection-based. There's very few lenders that will do a true projection-based loan for short-term rentals, and maybe you have some DTI issues, so you can't buy it as a conventional second home or an investment property from a standard or conventional standpoint. And that's where these non-bank, I'm going to call them portfolio lenders, come into play, is that they don't require tax returns. It's not based on DTI. It's based on credit score. It's based on loan to value and debt service coverage ratio. And they will use a projection-based DSCR based on AirDNA. They have their own formula to figuring this out. But we're going to kind of dive into the refinance options. There's a lot more refinance options for short-term rentals. So if you have 12 months of history, and you can show your VRBO or your Airbnb bookings, we can use that as income on a refinance. They want 12 months of the printout, and we can use that for your DSCR qualifications. So then we're just pricing it on, let's say, great income, it qualifies from a debt service standpoint, then it's based on loan to value and credit score. That's how these are all priced, because there's no tax returns. Rates do float a little bit, but nothing like conventional loans. They don't move 2 or 3 times in a day. So, that's critical. If you're running this, maybe you bought a property with short-term financing, maybe you went in and did a fix and flip loan, and then you rehab the property, you furnish the property, now you're running it as an Airbnb. You get to that 12-month point, now you're able to refinance. And we're refinancing based on market value. We're not looking at your income like a cap rate. Even though it's a commercial-based loan, it doesn't work like that in the residential space. But it appraises higher, the debt service coverage is there, then you've got yourself a loan. On a refinance, usually the max loan to value on a cash out is 75%. So just keep that in mind, that 75%. The options you do have are a 30-year fixed, straight 30-year fixed. There's a 5, a 7, and a 10-year fixed, all amortized over 30 years. Some of the programs have interest-only options, which might be a good idea. When they're priced, they're usually priced with a 5-year declining prepayment penalty. So that's a 5, 4, 3, 2, 1. You can increase rate a little bit and get a 3-year step-down prepay, which is a 3, 2, 1. So if it was a 3-year prepay, the first year, if you were to sell or refinance, you'd be penalized 3% of the principal loan balance. Next year would be 2%. Next year would be 1%. Fourth year, 0. There's no prepayment penalty.
The reality of today's economy is hitting home with employers. Employee turnover is now running at over 100% and costing over $2,000 to hire, train, and replace workers, let alone sky-high signing bonuses. But even within this new workplace dynamic, one of the core underlying realities that many American workers have is financial insecurity. 78% of Americans live paycheck to paycheck. 65% of employees feel that personal financial worries impact their health. 44% have less than $400 saved for unexpected expenses. What if one product could help solve both the immediate labor and hiring issues, and also address some of those longer-term worker insecurities and realities without adding $1 to your bottom line? Introducing the digital account with no monthly account fees, no credit checks, no minimum balances, and no overdraft fees. The account comes with a Visa debit card, global ATM network, bill pay, send money, and features Pay Any Day. Pay Any Day, a proven way to reduce employee turnover by as much as 40%. With Pay Any Day, employees can access up to 50% of their pay before payday. Pay Any Day is not a loan, it's an advance. And with a digital account, your employees can get their money when they need it. Your employees' satisfaction, financial wellness is critical to reducing turnover. Make their life easier and they will stay longer. Contact Expense Savvy today to learn about this amazing employee retention tool. Please visit expensesavvy.com/account.
So that's how these loans all work. What I've noticed lately is that more of the secondary market's coming in and they're coming out and saying, okay, we want to do more of these Airbnb or these short-term rental loans. So they all have a little bit different caveats on what they will do, what they won't do. The way I like to look at these deals, what's your credit score? How much are you putting down? What's your projection for annual gross short-term rental income? If this was going to be a long-term rental, what would it lease for on a long-term rental rate? What are the annual taxes? What's your insurance? Is there an HOA, right? And then I run my numbers. The reason I ask about the annual long-term rental rate is because I have more options. If the long-term rental rate would qualify from a debt service coverage ratio standpoint, then I can open up the door to all my portfolio loans, right? I don't have to just limit the pricing with one or two of my funds. So that's the real advantage, is knowing all this and being very clear. Then we find the best option based on the overall scenario. Another scenario, 12 months of printouts is very useful. Even if it's a short-term rental, if they do a market survey or a rental survey on the refinance, they'll use that long-term market rent as the qualifying income versus the Airbnb if you don't have 12 months of history. So there's hybrid methods we can underwrite. I just need to know these details up front when doing this. The other option is we're seeing, is I think I talked about it earlier in this show, fix and flip loan where you're getting a 12-month or an 18-month loan where you're going in and rehabbing and then creating value. Well, that's another strategy, right? You don't necessarily need to buy a turnkey house. You can rehab into it almost. It's like a BRRRR, buy and then renovate, refinance, repeat, but you're BRRRRing into a STR or short-term rental as opposed to doing the traditional BRRRR to a long-term hold. See a lot of my investors doing that model. I like that model because I always like to create value. But if you're just focused on running the STR business and don't want to hassle with renovating properties, which is kind of a pain in the butt, there's all these different avenues you can go. So anyway, I'll conclude this episode, but I just want to dive back in and give a kind of an update of what's going on in the world of STR financing. And it's very, very active. Like I said, more and more lenders are coming out with programs specific to short-term rentals. So I think it's just going to continue as this market's really growing. It's amazing to see how many people are investing in short-term rentals. And it appears like there's still runway, even though it seems like, whoa, so many people are doing it. Maybe it's not the best time, but tremendous runway, it looks like. But it is a business. So my friends that are doing this actively, you have to put systems in place. You got to be strategic with your financing. And remember, when you're going the non-bank route, the rates aren't as good. They're pretty good for not having to show tax returns and the ease of the transaction, but it's about a 1% difference in rate. But I would say overall, the rates are very aggressive right now in the non-bank world. I look forward to you joining us on future episodes, and feel free to download the podcast or go to the YouTube channel, which I think is people's preferred choice because they like to watch as well. But if you're on the road, you can always download on iTunes or Stitcher or whatever. I also have several other channels on YouTube. If you're interested, I have a channel dedicated to SBA financing. I have a channel that just rolled out for expense reduction, working with businesses to help them reduce their operating expenses and different services within that. So anyways, it's very exciting. Hope you enjoyed this episode, and I will talk to you soon.